I'm Steve Girrell, and I'm a principal with GA Investment Management, and I want to welcome you today to our featured speaker series. And we've had a number of these and topics ranging from Medicare, estate planning, long-term care, etc. And this will be recorded, so you'll be able to watch it after the fact by logging into GA Investment Management website, which is Retire with GA, or on our Facebook page. So that's terrific. There's also a little bar there on your Zoom that you can type in questions, and we will answer those questions during our presentation today. So we're really excited about our presenter. Today, we have Chad Roope, a chartered financial analyst and the chief investment officer of Fundamentum. And Fundamentum has become a great partner of GA. They're helping us with our very popular dividend strategy, and we're also learning and utilizing more of Chad and his team's portfolios, and they've been terrific. In fact, we have a new 5-star portfolio with Chad, so maybe we'll get to hear a little bit about that today. But prior to starting Fundamentum, Chad was with Tops Valmark Advisors, one of the largest ETF managers in the country at the time, over $5 billion in assets. And he also was with Charles Schwab as a private client portfolio consultant. So he worked with high net worth individuals at Charles Schwab. So he's got his degree in finance, magna cum laude, from Western Carolina. Congratulations. And then went over to England and studied the euro, right, Chad?
Yes.
That's
when it was new.
When it was brand new, and to see if perhaps it would work or not. Do we know the answer to that? But anyway, I want to thank you so much today for taking time out of your day to do this. And without further ado, here's Chad.
Thanks, Steve, and good afternoon, everyone. I just want to start by saying it's a great honor and privilege of ours to work with GA Investment Management and help you manage and them manage through these uncertain and uncharted waters. So we're going to get into a few things that worry us and keep us up at night right now, and we're going to look at some things that are positives for the market. And then we'll wrap that up into what we're actually doing about it. Just a few opening comments first. 2020 is going to be this year the year that's remembered as, the year something microscopic, invisible to the naked eye, severely tested capitalism in the United States. Capitalism needs the free movement of people, goods, and capital. They're the lubricants of the capitalistic model's engine. And this coronavirus has proven to be almost the perfect friction to this free movement of people, goods, and capital. And it's been unnerving. We've seen just how difficult it is for businesses to function and education systems to function, and let alone the terrible human tragedy that we've seen with 750,000 people about it who've succumbed to this virus. So it's just been such an incredibly challenging year. But at the same time, given all this bad news and all the volatility, the resiliency of our people and our capitalistic economy is just amazing. In short order here, doctors and scientists have developed 8 vaccines. And I think a lot of that is because of the University of Pittsburgh right there in a lot of your backyards. They had done a tremendous amount of research on coronaviruses many years, over the last several years. And so I think they really provided a strong platform for many of these drug companies to build upon. So, it's just amazing, the resiliency. And central banks and governments have really come together and implemented huge stimulus plans, which we'll look at in a minute. And here we are, the S&P 500 sitting at all-time highs. Tech stocks, have done incredibly well in the face of all this bad news. So where do we go from here? As investors, we're worried about what's out in front of us, not necessarily as much about what's behind us. So let's dig into that a little bit. First, I want to just tell you a little bit about our team. Steve introduced me, but more important than me is our wonderful team. We've got over 100 years of collective investment experience together. We've managed over 40 billion for some of the largest institutions, pension plans, sovereign wealth funds, and insurance companies all around the world. We hold the CFA designation, which is sort of the standard for investment management and the types of strategies we manage. And I think it's important to highlight that we don't offer our team and our strategies and services to just anyone across the country. We are exclusive to firms like GA Investment Management, who work with Stratos Wealth Partners. So we're entirely focused on close relationships with folks like Steve and the team at GA. So what's keeping us up at night? What's worrying us right now? A few different things. Obviously, first and foremost, the virus is still spreading. Now, as we can see on this chart here, it's come down some since the spikes in cases we saw in California, Texas, and Florida right in the middle of summer. But we're still elevated. The good news is the trend is down. And since this chart, which was August 18th, over the last week or so, the cases have continued to come down some, but we're still averaging around 40,000 new cases a day. So, and compare that to where we were back when the shutdown started back in spring, and you can see we're still higher levels than we were then. And of course, what we saw happen with some of the states that opened up early. After the shutdown, Georgia, Florida, Texas, California, many of them had to roll back some of those reopening plans. And as we'll see in a minute, that has started to impact some of the economic data. Question is, where are we going to go from here? Well, obviously, a huge issue facing us starting really over the last week or two and into the coming weeks is schools reopening. And as I'm sure you've seen on the news, schools in the South, which opened earlier than some, others, certainly in this area, have had some strong difficulties, let's just put it that way. And many of the universities, such as University of North Carolina, Chapel Hill, and Notre Dame, opened, and then pretty quickly, within a week or so, had to resort back to online classes. And that just creates all sorts of difficulties with rents and tuition and commitments to landlords. So just a number of issues. So this thing, the bottom line is, while we do have 8 vaccines in phase 3 trial, we're still far away from having this virus under control. So, the question is, as we go into the fall school season, we go into the typical flu season, how is this going to interact with the virus? And are we going to get more information about vaccines in time to where we don't have to go back to shutting down the economy the way we did before? So that's something, that we just don't know the answer to. The cases are still high, trending down recently, but are they going to spike back up with the opening of schools? Just going to have to wait and see. Certainly a worry top of mind for us. And really this feeds into a bigger issue with the economy and employment. So as you can see in this graph here, over the last several years, the unemployment rate had come down to, levels we hadn't seen since the 1950s, well under 4%. Well, with the shutdowns that started in March, you can see this huge spike up to, close to 15%, and then we've trended back down to 10.2. But we're afraid with what happened in California, Texas, and Florida, and then what may be happening with schools, maybe we're going to see that start leveling off and maybe turn back up. Now, why is this important? You and I, the consumers in the United States, working, earning our paycheck, going out into the economy and spending money, we're 70% of gross domestic product, about in the US. So if a huge percentage of us are unemployed, that 70% of GDP number is certainly at risk. And let me just put this into perspective. At the heights of the global financial crisis in the fall of 2008 and winter first few months of 2009, the peak unemployment rate was 10%. 10. We're still higher than that with this particular recession. And we are worried, again, that maybe this 10.2% number could be a low point for the moment. So there's a measure called the Challenger Jobs Cut Report that we follow closely. And of course, we expected to see this huge spike into February and March and into April of companies announcing job cuts. That's essentially what this is measuring. And notice that we had a big job cut reversal, big slide down from April into the end of June. But when we saw the rollbacks starting in Florida, Texas, California with the virus, look what happened in July. A big spike in job cuts. So we're really worried about this 10.2% rate in light of the rollbacks and increase in job cuts in July, and how that 70% of the economy is impacted by people out of work. And feeding into that is consumer confidence. So if we're not feeling too confident as a whole, consumers out earning money, spending money in the economy, if we're not confident, we're probably not likely to spend. And if we're 70% of the economy, that's a problem. So what we've seen here is a huge bounce off the lows in consumer confidence. Of course, you'd expect it to just crater, like you saw it here from the peak in late January, early February, just cratered through the shutdown. But then, sort of like the other data we saw earlier with the sharp drop in job cuts, the sharp drop in the unemployment rate, well, we saw a sharp uptick in consumer confidence. And this is a measure by Bloomberg, which is measured weekly. We saw a sharp uptick, but look what happened here again in July. We saw it leveling off, and now we're starting to see it fall off. So again, we're just worried that the virus uptick that started with Florida, Texas, California, now we're going into school season, we're going into flu season, we're starting to see some of this data level off or roll over. It's troublesome for us. Now, of course, we've got a very unusual election coming up here in just a few days. So obviously that's another worry. But the good news is if we set all the rhetoric aside and we don't get too emotional about one side or the other and just look at the data going back to World War II, where I've got these two arrows. The thing I want to point to first is this post-election year percent up years, total years. I don't know if you can see my mouse there, but I'm circling it. 61% of the time, going back to post-World War II, the year after the election is positive. Okay, now if we move down here to this bottom graph, what we notice is the average gains in the year post-election. Under Republicans, it's positive. Under Democrats, it's positive. If the incumbent party wins, typically positive. If the incumbent party loses, not quite as good, but typically positive. Incumbent Republican wins, positive. Incumbent Democrat, not really the case this time. But if the incumbent Republican loses, tends to be positive. So what we will do in this case, it's a very heated, very unusual election. 2016, heated and unusual and a surprise in some ways. This one's going to be no different. So what we're going to do is try to take the emotion out of it. We're going to lean into this historical data and say, could 2021 be a difficult year for the stock market? Of course it could. But history would say that the post-election years tend to lean positive regardless of the outcome. So that's a good base case to keep in mind as we go into an emotionally charged season. Always an emotionally charged election season, but this one in particular. Now, as it stands right now, I think the market is a little worried about taxes potentially with a Democrat win for the presidency and a sweep in Congress. That could create a little bit of uncertainty, but again, let's go back to this data and not get too excited one way or the other. But as it stands right now, Joe Biden has a bit of a lead in the polls. This is the Financial Times poll tracker that you can Google. It's free to follow. So this might be something interesting you want to follow along with. But again, let's set emotion aside and let's think about something that may be a predictor for us. If we go back to 1928, and we look at how the stock market did in the 3 months leading up to the election. If the return was positive, the incumbent typically won. If it was negative, they typically lost. Okay? So, and this has been correct in 20 of the 23 prior elections. Okay? And so incumbent needs the stock market to do well in the 90 days leading up to the election. That this is going to be another interesting thing that you can follow quite easily. How has the stock market done since August the 2nd of 2020? So far, it's positive. Well, we still got a long way to go, but something to keep in mind. It has a pretty good track record of giving you the election outcome. Regardless, the election is an uncertainty in a very uncertain environment. Now, one thing we are worried about is the price of stocks relative to a lot of different measures. You've probably all heard of the price to earnings ratio. We look at those on earnings looking backwards. We look at that on earnings looking forward, projected earnings for the next 12 months. We look at it current price divided by an average of the last 10 years of earnings. We look at price to book, price to cash flow, and price to the GDP ratio, which we'll look at in just a minute. Now, by most measures, valuations are stretched. Prices are high relative to fundamental measures of the stock market and companies. Okay, so prices relative to the earnings power of a lot of these measures are quite high relative to history. Okay, so presently, if we use forward projected earnings, analysts across Wall Street projecting what they think earnings are going to be over the next year, and we compare that to the price of where it is, we're at about 22.5. And as you can see, the 25-year average is about 16.5. Quite a bit higher, okay? More than one standard deviation higher, and approaching the levels we saw in 1999. Now here is an ugly chart, I'll admit it. But this is Warren Buffett's favorite measure of the stock market. It takes the value of our entire economy, gross domestic product, and divides it by the value of the S&P 500. Okay, don't get too lost in this chart. Tough to read, only for people like me who are interested in the details of this thing. The point here is the stock market is nearly worth twice as much as our economy. Typically, we've seen about a 1-to-1 ratio there, maybe the stock market being a little bit higher, but certainly not nearly 2 times higher. Okay, at the height of the dot-com bubble issue back to 2000, it was about 140%. Okay, almost a time and a half size. Now we're nearly 2 times the size. Okay, so if we look at most valuation metrics, prices relative to fundamentals of the economy and the stock market, things look expensive. Okay, but what we have to take into account is the fact that interest rates, and I'm sure you've noticed this on your bank account statements, are virtually zero. So if we are investors looking to bring future cash flows back to the present to decide if something is what the value of something is, discounting cash flows to the present, low interest rates means higher prices. Okay, so nowhere in these look back periods, the last 25 years, going way back in this chart to 1925, have we seen interest rates this low for this long. So if we're discounting cash flows back to the present using really low rates, it makes sense that prices are higher than what you might have seen historically. So the question is it too much? Don't know the answer to that. Something we're going to continue to watch, but it is a worry if interest rates start moving higher. Okay, so that's the key here. If interest rates can stay this low for a long period into the future, maybe these metrics don't look too high. If interest rates move up by 0.5 point or 1 point, that can materially change things. So we'll look more about that in just a moment. Inflation being a key reason rates could go higher. Okay, it's really low right now. This is just the Consumer Price Index for the United States going back to the 1950s. You remember some of you remember the 70s and 80s and high inflation. Well, we're running about 1%, as you can see over here in this chart right now. Really low now. Another reason prices can be higher, valuations can be higher because rates are low, because inflation is low. But notice over here on the right-hand side of this chart, this is the monetary supply. This is cash in the economy. What the Federal Reserve has done and what Congress has done, but primarily what the Federal Reserve has done, and we'll look at some data on this in a minute, in response to the coronavirus recession, is they have increased the monetary supply at a rate unlike anything we have ever seen before. Okay, so the amount of money, liquidity, that's awash in the financial system, and that's a key. Most of this is still in the financial system, not in the real economy. If it starts leaking out into the economy by banks lending money significantly, they've been tightening lending standards, not increasing lending standards. But if they were to start that, and this huge amount of money supply growth start seeping into the real economy, this inflation chart could start looking quite differently, meaning the interest rate picture that we talked about before could start changing, meaning valuations might start looking more expensive. Okay, so it's not something we think is imminent. it's something we think might be a 2021 issue. Now, what we're watching to see if there's any change in this is something called the velocity of money. It's simply how quickly money is changing hands throughout the economy. If it's changing hands faster, typically inflation's moving higher. If it's changing hands at a slower rate, typically inflation is subdued or moving lower. Well, notice this. It's at an all-time low dating back to the 1950s. Okay, so money, I mentioned that a lot of this money supply growth, this huge increase in money supply growth, is still in the financial system. It's living in a lot of cases on bank balance sheets, and they're just not lending. If they start lending, we might start seeing this velocity pick up. It would be a leading indicator for us that interest rates might be moving higher. Okay, so something our team is watching. Again, this isn't a very short-term issue. It's something we're worried about, though. Okay. The other issue, again, these are going to be two charts here. Don't get too lost in looking at the charts. They are things that I like looking at, but you probably don't care to look at. They're hard to focus on. They're short-term market indicators of extreme optimism or pessimism. Okay. The top one here is showing us the crowd, right? What are most investors thinking out there? How are they feeling about their investment accounts? Well, as you can imagine, given how stocks have roared back since late March and hit all-time new highs, well, a lot of investors are feeling really good, feeling extremely optimistic. Well, that's typically a bearish signal for the stock market. When people get really excited about the stock market, typically what follows is things move down in the short run. Okay. Another thing we do is follow the stock market relative to its long-term trend. And this upper band you can see here on the bottom chart, the blue line is above this band of about 1.5 times its long-term trend, meaning exactly what this top chart is telling you. Investors have voted with their wallets and are feeling pretty optimistic at the moment. Typically means it's typically what we call a contrarian indicator. In the shorter run, maybe things have gotten a little bit ahead of themselves and it should at least level off, cool off for just a bit. Maybe we don't see a huge drop in the stock market, but maybe we just see things level off. That's what these optimistic, extreme optimism, these short-term technical indicators typically tell us. Now, this is a trading composite sort of surveying professional traders and how they're feeling about the market, similar to the crowd poll. The more optimistic, typically it's a contrarian indicator. Shorter run, maybe things cool off a little bit. So traders are very optimistic as well. All right, several things there we're very worried about or mildly worried about. Okay, virus being worry number one. The employment situation, big worry number two. Valuations and interest rates, a worry. Maybe not before the end of the year, a huge worry, but something that's worrying us, we're paying attention to. Some of these shorter term indicators of sentiment, maybe a little stretched, maybe we have a little bit of a breather here in the shorter run. We'll see. Let's turn now to some reasons for optimism. There's an old adage on Wall Street, a pretty famous investor, Marty Zweig. He coined this term, don't fight the Fed. In this environment, as we're going to look in a minute, we believe it's don't fight the Fed, don't fight Congress, and don't fight the scientists and doctors developing a vaccine. All three of those together are a very powerful combination that has led to this rally that we've seen since March 23rd, all-time new highs. They're very powerful as we move forward. So as we looked at in that money supply chart, massive spike. This is a picture of the Federal Reserve's balance sheet. What the Fed does is essentially create money and go into the financial markets, historically just the treasury markets and some into mortgage-backed markets, Fannie Mae and Freddie Mac mortgages. Historically, what they've done is they would create money, go into the market, buy bonds, and hold them on their balance sheet, just like you would. If you buy a bond, it's an asset to you on your balance sheet. That's what the Federal Reserve does. What's different this time is they've waded into corporate bonds too. So they've been buying treasuries, they've been buying mortgage-backed bonds, they've been buying corporate bonds, they've been buying corporate bond ETFs, unthinkable things for the Fed to buy and let live on their balance sheet. But notice, since the financial crisis, toward the middle of this chart, the Fed has been on this path of really creating a lot of money and buying a lot of fixed income as a result. What that's done is push rates to zero. And this latest spike, notice it here on the right side. Okay, it looks a lot like that money supply growth. Huge spike, okay? And that has really pushed interest rates down. That's pushed spreads on corporate bonds to all-time lows, meaning their prices are at all-time highs. Their balance sheet from late March of this year increased by 75% from around $4 trillion, you can see right here, to over $7 trillion in a very short amount of time, okay? Not only did they do this, they have signaled that, hey, we are going to do whatever it takes. If it takes taking this balance sheet a lot higher, if it takes us providing loans to companies directly so that they can stay solvent until this virus is gone, we're going to do whatever it takes to make sure that we help bridge the gap until the virus is gone. That is very powerful, and we don't want to fight the Fed. Chairman Powell has been very clear. I have a lot of tools in my toolkit, and I will use them if I need to. So we're going to take him at his word, and we're not going to fight him. What this means is, as you've seen since March 23rd, that's when this balance sheet really started to grow. Stocks have been on a one-way rocket ship higher since then. As long as Mr. Powell and the Federal Reserve is as dovish as they are right now, we're not going to fight them. Same thing with Congress. We're not going to fight Congress. They have spent over or nearly 12% of GDP, $2.5 trillion, to bridge this gap for the economy until the virus is gone, or at least controlled, okay? We're expecting another 1 to 2 trillion from Congress coming soon. They're fighting like only Congress can. They are in this perpetual state of gridlock, it seems, but they acted real quick when they had to back in March. We think they're going to really start feeling the heat from people on unemployment soon, and we think we're going to see more stimulus from them. Already seen about 12% of GDP. Maybe we'll see another 5% here in the short run. We're not going to fight that. It helped the stock market and bond markets in March. We think it's going to continue to through year end. And finally, don't fight the Fed. Don't fight the doctors and scientists developing vaccine. Now, this is just remarkable. And as I mentioned, I think quite a bit of it started right there at the University of Pittsburgh. But in very short order here, we have developed, and by the way, this is something you can track too. Just Google New York Times vaccine tracker. This is something you can follow right along with. It's no proprietary information that we have. You can follow right along. There are 8 drugs in phase 3 trials. This doesn't mean that they're testing these things on animals. These are testing on huge populations of people. Johnson & Johnson, for example, their phase 3 trial is over 60,000 people. So we think that one of these 8 or a combination of all are likely to come through here. And even Dr. Fauci has mentioned that he thinks by year end or early 2020, there'll be an effective vaccine, okay, which should allow us to have herd immunity, which should allow us to get back to schools and back to work and back to the free movement of people, capital, and goods in the economy. And not only that, we've developed several promising vaccine or treatments once people actually get COVID. So a vaccine for the virus and treatments for the disease itself. We're not going to fight that. We think we have some extraordinary doctors and scientists. We're very thankful for them, and we think they're likely to come through. We're not going to fight that. That's great news. The other good news is while we have seen some of those employment data and confidence data flatten out and potentially rolling over, what we're witnessing within the manufacturing sector, which is typically a leading indicator for the economy, is strong expansion. Of course, we saw this huge fall off, just like we saw with the other charts going into the crisis and through the shutdown. But since then, it's up. And when this thing is above 50, it's a survey. When more than 50% of manufacturers are saying we are growing, it's good for the economy. The economy is growing. Well, right now it's at about 54.2. You can see the peak that we had back in 2018 was around 60. So people and businesses are actually spending money and buying things from the manufacturing sector. And this is good news for the economy. What we're worried about, though, the flip side of this is, again, if we look at those confidence numbers, we look at the unemployment numbers, if we don't get some action from Congress, if we don't get a vaccine, these numbers could start petering out as well. So good news for now, something to watch, generally positive news for the moment. Now, just like stocks and bonds, real estate is a function of interest rates. Low interest rates means your house is worth more. And these are new purchases for homes in the Mortgage Bankers Association issues this data. The housing market is lights out strong. We've not seen anything like this since the mid-2000s. Notice this chart since March, boom, straight up. A lot of this is people maybe moving out of New York City and out of Chicago and San Francisco, the big cities, and moving to other places of the country since they can work remotely. Maybe that's part of it, but interest rates are so low, real estate prices are going to move up too. And as you know, looking at your personal balance sheet, it's a substantial portion of your assets. That's the case across the country. A major asset for many homes, or for many households, is their home. And if their home is worth more, they typically have more liquidity. They can take out home equity lines. It's generally a good sign for the economy. Other high frequency data. Again, don't get lost in these numbers. I'm going to talk about them in these squiggly lines, but things that tell us something about how we're behaving as consumers can tell us something about the future of the economy. So how many people are traveling? How many people are going through the TSA turnstiles at airports? Well, as you can imagine, it was virtually zero back in March and April, but it's come back some. Okay, we're up about 30% from that level. We're still down 70% from where we were in the future, but people are beginning to travel more. People are going out for dinner. We're at about half the levels we were before the virus hit, but we're improving. Hotel occupancy, about half better than it was at the worst part of the lockdowns. Okay, we talked about mortgage applications. That's unbelievable. People are spending money on their credit and debit cards. Okay, not where we were before, but improving. Now, what typically matters, Liz and Saunders, Steve mentioned I worked at Schwab. I have a lot of respect for Liz Ann. She's the chief strategist at Schwab. She always says, for the stock market, it's not about whether data is good or bad. It's about whether it's better or worse. So this high frequency data, things that we can measure, high frequency just meaning we can measure it day to day to day to day to day, rather than some of these survey data like manufacturing activity, which is once a month. What we're getting here is a sense that people are feeling more comfortable going out to dinner, flying, going to hotels, using their credit cards, gasoline usage, not on here, going up. Okay, people are driving. So it's getting better. That's what matters to the stock market and the bond markets. That's good news. Okay, way down from where it was, but trending in the right direction. Here's another one, a little busy chart, but the New York Federal Reserve has a high frequency index, a weekly index that measures things like steel production and electricity output and fuel usage and railroad traffic and the amount of taxes that's being collected by the IRS. Okay, notice this chart is really bounced off the bottom in March, but it's continuing to move higher. Okay, that tells us some of the shorter term data that can be measured week by week by week is beginning to look better. Way off where we were, but looking better. Okay, again, virus gets worse with the fall, virus gets worse with flu season. Maybe we see consumer confidence weaken. Maybe we see this unemployment situation get a little worse. Well, we'd expect that to flow through to some of this high frequency data. But for now, it's not. That's good news, getting better. Okay, bottom line here. Challenges include virus is still spreading. Unemployment levels high. We got the election. Valuations are stretched. But we're not going to fight the Fed. We're not going to fight Congress. We're not going to fight the doctors and scientists creating a vaccine treatments. We think that they will succeed in that. So as a result, given putting all that together, we think valuations are important. So we're not going to be overly optimistic like we saw a lot of those traders in the crowd be. Okay, I'm guessing you probably feel the same way. Things feel a little excessive. We would agree. So we're going to be a little defensive. But we're not going to fight the Fed, Congress, and doctors and scientists. So we're going to keep some exposure, higher levels of exposure than we probably otherwise would, given those three powerful forces. And we're going to keep higher levels of cash and a distinct tilt toward good balance sheets. Okay, companies that can grow cash flow, who don't have high levels of debt. That's what we're going to be focusing on. Okay, and the bottom line for you really is you've probably seen this chart from Steve before. This is, and others at GA. These are the stocks in the total return portfolio. Okay, you're worried about dividend income. The bottom line for you is, in one of the most challenging environments ever, capitalism's been tested like never before. We've had the deepest recession ever. It's been the shortest probably, but the deepest. We had one dividend cut, Wells Fargo, so far this year. We were expecting Wells Fargo to cut the dividend by about a third, which would have still left it at a level we would have thought would have been good. They cut it by 80%. We sold it and we bought US Bank Corp, which has slightly lower yield before Wells Fargo cut their dividend, now a better yield. Bottom line is, in an awful environment for most companies, we've had one dividend cut and we did something about it. So your dividend income is still coming. Several of the companies have actually increased their dividends, companies like Johnson & Johnson, for example. So let's focus on the positives, tune out what's undoubtedly going to be a terrible election season in terms of back and forth and rhetoric, and a lot of people angry with each other. Let's just try to tune that out. Let's focus on the positives. Let's focus on the fact that we're still getting good dividend income. And let's lean into the fact that usually post-election years are typically Thanks so much for your time, Steve. I'll turn it back to you.
Chad, thank you very much. That was when I saw your little slide deck and all of those graphs, I thought, oh my goodness, I don't know if I'll be able to stay awake through this. But you did a great job, and they were really excellent information. I do have one question, and this is one that's been, right now it looks kind of like a V. A lot of those charts you showed, we showed that the fall off in March like a cliff, but a rebound. And in some of them, we saw this a beginning of a weakening. And the question is, do you expect a W, and especially with the small companies leading the way? And I think that is a big risk, don't you?
It is, yeah. And if we look at the NFIB small company surveys, there's some weakness there for sure. And if we just look at the price of small cap stocks, they've come back some, but nothing like the big caps. And we know that small businesses employ the most Americans. So it is an issue that we're watching. To be quite honest with you, I don't know the answer to that question. It's something we're going to have to monitor closely. My belief is we are likely to have this sort of square root where things level off for a bit. Okay, I think between now and the end of the year, we could certainly see this virus issue get worse, the unemployment things get worse. But ultimately, I think the doctors and scientists went out here over the virus. I think we get the herd immunity, and I think in 2021 we'll get some resemblance of what we thought was normal returning. So in terms of the economy, I think we will continue to see a bumpy journey with the trend leaning toward an improving economy. The stock market has priced in a lot of good news. So I wouldn't be surprised if this disconnect that we've seen between stocks, good economy, most people on Main Street not feeling so great, a lot of people on Wall Street feeling wonderful. I think that disconnect could start closing by the economy improving, okay? And maybe stocks taking a shorter term breather with some of those shorter term indicators that we look at.
Oh, that's,
my worry though is longer term about this inflation story. Ben Bernanke was in Congress mid-July, and he said, we don't have to worry about inflation at all. He's the one who created this balance sheet expansion to start with. And he said, we don't have to worry about inflation. Look, we've got evidence. It didn't happen after 08 and 09. I think this could be different. And I think interest rates moving higher wouldn't have to be a lot. That could cause some problems for the stock market. So we're just going to have to wait and see.
Yeah, that would be quite the unknown, Chad. And it's not just the stock market with interest rates rising, but just think of financing this government at this point in time.
My kiddos may not have quite the same experience as we have.
Yes. Well, Chad, I want to thank you again. Thank you very much. That was excellent. And for those that didn't get to watch, we will have this up on our website, etc. So thanks, and have a great rest of your day.
Thanks so much.
Bye-bye.